Thank you very much, Cindy Brooks, for that nice, warm introduction as usual. And I am here with one of my most original first clients, Mr. Spencer Cullor of Apartment Investors. And let me, Spencer, let me read everyone your bio, and I'm gonna pick it apart a little bit.
Okay.
Yeah. So he's a graduate of University of Kansas, and as we all know, and everybody knows, it's because he couldn't get into Boston College, but he also obviously couldn't get into UMKC because, as I heard, they have very good professors there, like my brother, and but he got a Bachelor of Science in Business Administration with a marketing and finance emphasis. Okay. Which is great to hear because, as you always hear me talk about multifamily, it's all about the marketing. Everything has to do with marketing. All business is marketing. So, but here's the really cool thing about Spencer's bio, and this is, I'm going to really delve into this, is about how broad a spectrum of experience he has with real estate, like being a home builder, managing crews of guys, adding such a great amount of equity. Let me see if I can give you the numbers here. His first multifamily investment, I think I was involved in that one as well. He put together a private investment group to purchase, rehab, and improve the management to increase the value by over 75% and to create cash flow of over $8,000 per month in under 18 months. Folks, that's how millions get made in the multifamily business. And he currently lives in Overland Park, Kansas. And just for those of you that don't know, that's the nice part. That's where college professors can't live. And he's finally, look at, when you started with me, you didn't have a family. Now you got a nice little daughter, Collins. And,
yeah.
I really appreciate the fact that, you got a family dog named Char, which, as everyone knows, that's short for Charlie. I like the fact that you named your dog after me. That was very nice of you, Spencer. So Spencer, how you doing, buddy?
I'm doing great. How are you?
Very well. Good to see you, man. I tell you, it's so cool to see you and your progression. And I just had another one of my students on who's over 5,000 apartments right now. Actually, this guy started about the same time you did. Believe it or not, I'm not no judgment.
They're blowing us out of the water.
No, that was not what I meant when I said that. Not at all. But it just, the success of both of you guys is so fantastic. But you are approaching 1,000 apartment units right now. You and your dad, and is it still just you and your dad?
It is. It is
so
right
cool.
now.
That's so cool. Yeah, and so you're coming up on 1,000. You're about 600 now. You're going to be doing some other big deals coming up.
Yeah, we've got a couple things in the work. I think we'll be at 1,000 by the end of the year.
That is so cool. Congratulations.
Thank you.
Stand up and applaud. Bravo to you. That's awesome.
It's been an interesting journey.
Yeah. All right. Well, that's what we're here to talk about, because I want, and the part about this being the best multifamily podcast ever is we teach stuff, but we also, interview guys like you. And the whole point of what I teach is I want to know the good, the bad, and the ugly. I want to know what's a day in the life like with Spencer. I want to hear about your worst day. I want to hear about your best day. Really give a good vision for people as to what happens. And then another thing we're going to talk about is money. And how and I remember you had I talked about the way that you were doing your deal structures to a lot of classes that I taught at, because it's a very unique way to do it. Because, people always go, how do I structure deals? And I have to tell them, hey, there's so many different ways to do it. I have one student that does this, and I have another student who does this. And they all wanted to be you, Spencer. They all wanted to be you. So let's get started. Let's back up a little bit and talk about your real estate, expertise. Because when you and I started working, we started working together on your first multifamily deal, but you and your dad had been doing stuff before that. So
yeah, we had built homes and done spec homes and sold those. My brother and I always built our own homes, and so that led into some spec homes that we were doing. I was working a full-time job as well, so I was doing this on the side, and then got into a retail property, and we had some farmland and some rock quarries that we leased out, and then led into the multifamily side, which is where I felt like our skill set really best gelled.
Okay, but let me ask you this, because this is kind of interesting. I've never had anybody with that type of a resume before that I could speak to. Out of all of those facets of the real estate business, how does the multifamily business compare?
Well, for us, it's been probably the most profitable and the most consistent. Um, the others, I mean, there's pluses and minuses to each one. Building homes was fun because you got to create from scratch.
Yeah,
The
yeah.
things I didn't like about it is you had to wait 6 to 9 months to find out if you made any money. And
Oh,
every time you sold a house, you were out of business until you had the next house.
yeah,
Or
yeah. I mean, that's why people get into multifamily. They do the fix and flip side, and they realize they're only, they just, killed their business
yeah,
once
you're
they
just
flip.
continually spinning, trying to find a new property. So the thing I've really liked about the multifamily side is, we've had a couple properties now, one for 7 years, another for 5, another for 4. So we've kept them for a long time, and we've made money all the way along the
That's
way.
great. That is so cool. Now, one of the things that the way you found your first deal, I got to tell you that, listening to you, how you did it, I've really started to stress that to my students. And when we do our initial action plan as to how to get up and running, I say, this is the first thing you're going to do. Why don't you tell everybody how you found your first deal?
Well, I was one of those crazy people that actually found it through a letter campaign that
Yes,
I did.
exactly. Direct mail. It
Yeah, at the
works every time it's
time,
tried.
it was really hard to find a list of property owners for multifamily. So that was one of the hardest things we did was we went to the courthouse steps, got list of multifamily owners, and then just did mailings at
Yeah.
first.
And now, did you get it right away, or how many mailings did you do before you started to get systems?
Um, this one actually came on the first mailing, but from the first letter, but it took them 6 months to reach out to us.
Exactly. Yeah.
They kept
Yeah.
doing their thing, and then when he started considering it, he gave me a call. I actually went and negotiated the deal over his kitchen table, which
Okay.
is
Okay.
part.
Let's talk about that. So you get a phone call from this guy,
Mhm.
and I can tell one of the problems that a lot of my students have is, the owners, when they call that type of a letter campaign, they start to play cat and mouse over the phone. Like, well, how much are you going to buy it for? How much are you going to buy it for? It's like, well, I haven't seen anything of it yet.
Yeah.
How did those conversations go with you? How many conversations did it take?
It took a couple. One, I think one of the first things they're trying to do is find out what their property's worth, because a lot of them aren't sure. They kind of maybe have an idea in their head, but they're not really sure what somebody's willing to pay for it out in the market. This is a guy that had held this property for like 20 years. So he bought it right from the owner. He'd held it, and he was a doctor and owned this property on the side. So it wasn't his main business. He just had it as a side investment.
Yeah.
So the main thing is they wanted to test my credibility. They wanted to kind of find out what the market was for it, but then getting them comfortable with sending you the financials on it is the hard part. We always did that we'd offer them a non-disclosure agreement as one of those things. And they also want to know if you're a broker or not.
Yeah. Yeah. Now it's interesting that like your first letter campaign, the first time out of the box, you found that perfect type of owner that we were all looking for.
Yeah. Well, we got several calls. We just sorted through to finally finding one that, there were some that were just kicking tires and wanted to see what a value might be. Or
now, when did you get really excited about this deal? Like,
when he finally let me go see it, and it was actually in our town. So I had driven past it before, but when I first got to tour it, and when he was serious about a number, that's when I really started to get excited about it.
Okay. All right. Now, who talked the number first? Who mentioned price first?
I did on this one. He gave me the financials. I, told him what I thought we could do. And
did your coach tell you to do that, Spencer?
It's been a while, Charlie.
Oh, we're going back there, man. We're going back there.
Yeah.
Way back machine today.
But I thought we came with the number that worked for us.
Yeah. Yeah.
And luckily we weren't that far off from what he thought it was worth. So
okay.
That
So
usually a lot of times doesn't happen.
Yeah,
but
no
in
kidding.
this case, it did. We were close enough that we were able to get it under contract, and then do the inspections, and I actually then did kind of a renegotiation after the inspections at his kitchen table with he and his partner.
Yeah. Now, what did the inspection turn up?
The main thing was, I mean, it just had some deferred maintenance on it that
Yeah.
needed to be cured. I think a couple of the roofs were in poor shape. So that's what I actually negotiated mostly was that, I apologize for that, was for the roofs to get
Okay.
fixed.
And that was pretty much it. How was the occupancy? How was it? How was the building? How was the property as a business?
The structure of it was in really good shape, but it hadn't been upgraded at all in 25 years. So it was very tired and dated.
Yeah. So what'd you do?
We actually negotiated that deal with them. We ended up getting a $25,000 repair credit for the roofs and decks. There were some decks that were they went across the front of this building. They were actually kind of falling apart,
Okay.
deteriorating.
Yeah.
So we got a credit for that. Ended up getting the property under contract finally for just around $30,000 a door.
Okay. Because I know how many units it was. Can I
It
give
was a
can I
40
give-
unit deal.
Yeah,
Yes.
1.2, 1.2.
Yeah,
So
and we ended up at 1.75 or 1.175.
right. Okay.
Yeah.
All right. Now, you guys have never done this before. You've got a reputation. Your dad's been a good businessman for years. How do you get this deal financed?
We went to a couple different banks. We ended up with a bank out of town that actually financed it out of Nebraska. And they financed the deal, and we put down the 25%.
Okay, so it was 25% down. What little local bank? So you probably were you weren't dealing with 30-year amortization, right?
No, it was 20-year amortization,
Oh, wow.
5-year fixed, but very low fees.
Oh.
Banks will
You make it up
definitely,
on volume.
no points, nothing like that. So, and no prepayment penalties, which was,
Okay, and the fact when you put those numbers in, the deal still worked.
it did.
Okay.
At that time, I'm embarrassed to say it probably had a 15% cash on cash return going into it,
Wow.
which that's
Nice.
pretty difficult to find these days. But
Yeah, exactly.
yeah.
And the problem is that so many people are still looking for those types of deals right now, and you can't do it in the cash on cash. No.
You might get it after doing renovations and bumping rents and things like that, but
Yeah.
going in, you're not going to find that.
Because the market's tight right now. It's very tight. Everyone's looking for good deals. Now, all right, so we got to ask the $1 million question, the barrier to entry, the down payment. How'd you do that?
We actually did it through, I got my first private investor, which ended up being my father in this deal. So I went out, found the deal, did all the work. He had actually sold some land that he bought for $25,000 in 1970. Sold it for $250 that we put down on the deal. And
folks, let me tell you that you were about to see follow the bouncing ball through this thing. This is how the Democrats obviously don't like people in flyover country to begin with, but when they find out how the rich keep getting richer, which you're about to see in this deal, because Gary did this shows you. Gary bought a nice piece of land early on, and watch how he parlays this thing.
Well, that piece of land made no income at all.
Yeah.
Cost money. Yeah, cost money and taxes and insurance every year.
Yep.
Ended up selling that 1031ing into this property.
Okay. He was probably so glad to see you coming along with this deal.
Right.
Yeah.
Right. And it was scheduled to, I think, make $50,000 a year on that, or somewhere close to that.
Okay, wait a minute.
Well, not quite that much at the time.
Okay,
it was about 15% return on that. So it was more like 40,000 or so.
But he's sitting there with a piece of land that earns him nothing, and then he goes to making between 40,000, 50,000.
Right. And that's where we really learned the power of commercial real estate and multifamily real estate compared to other real estate classes that we dealt with, where, that was like selling a home.
Yeah.
But you got
all we're talking about right now is the cash on cash return. We're not even talking about the power of the cap rates. that cash on cash return is just profit.
Right.
We're not even
Or the depreciation or
talking.
any of the tax write-offs or all the tenants paying down your loan for you.
Yeah.
Was,
When
on
you,
a 20-year loan is great.
what? Oh, no kidding. No kidding. Now, when you come to one of my classes, Spencer, when I'm out there in Kansas City, and you see me talking about the 5 ways you make money in multifamily, I think you just named 3 of them right off the bat, right there. It's the only type of business where there are 5 ways to make money. I mean, when you try to compare it to a Subway franchise, there's only one way to make money in a Subway
Right.
franchise. Multifamily, there are 5 ways to make money, and we're gonna touch upon all of them in just a moment. I know what the other 2 are, and I know what you're gonna tell me. So your father was psyched to get this, move his money, get into your deal. Now let's talk.
We were worried that the deal was too small though, because we'd heard all these gurus and stuff talking about you got to get to
Go
100
big,
plus
go home.
units as fast as you possibly can.
Oh, God, kill me now.
Little ones are, and they basically put them in a different class.
Yeah. No, I tell you, I've got one student who I just was on one of my podcasts. I mean, the guy, he's buying his biggest property now, and it's 55 units.
Mm-hmm.
And all of his, he owns 5 properties, all under currently in the aggregate, he owns fewer than 100 units. But that's the size property he owns. And the guy is a multimillionaire, and he lives a very nice lifestyle just with these properties. He buys them all himself, no partners. And he's got a beautiful lifestyle.
If you can do that, that's the way to go.
Exactly. So good for you. I appreciate you saying that, because I got these, so many people come from the 10X mentality of go big or go home. And it's just like, no, just build it the right way.
Yeah. Well, especially if you're starting out. I mean, you don't want to make mistakes on 100, 200 unit property out of the gate. It's way harder to recover from them than on a small property.
Exactly. Yeah. All right. So you get this property, the keys get turned over to you. You've never done this before. How are you handling the management?
Well, we hired a management company out of the gate. We did some interviews and hired one because we're told that's what you do. Hire a management company. After a couple months, they weren't getting us reports. They weren't getting us financials. The occupancy was going down. So we started asking questions. They couldn't come up with answers. So we ended up firing them, going to a different management company that we had a better reputation, put together a budget for us and things. And we stuck with them for about 4 more months. We're having the same kind of difficulty, but occupancy went down even further.
Spencer, what is it? What was their problem? What was going on?
Well, I think one of it is smaller properties can be more difficult to manage because you don't have the payroll to do a full-time manager or maintenance person. And if they don't have another property close by or an office close by, it's not big enough where it needs a full-time person all the time. And it's not, but it still needs somebody to come over there. And so they were trying to set, appointments for showing 2 days out all together, and then people wouldn't show up because they'd go out and find a different apartment in the meantime.
Yeah. So what ended up happening?
Well, we decided that I had gotten them into this. I was going to really get in there and learn the business. So I took over the management side of it.
Now, didn't you work with my buddy?
Jeff Ecker?
Yeah.
Yeah, we've worked with them since, actually.
Oh, okay, great, excellent. Because what I tell them. Okay, perfect. Because I teach people you're going to become your own property management company. That's just the way it works.
Yes.
And the easiest way to do it is to work with my property accountant, Jeff Ecker.
Yeah, and that's what we did.
Good.
So we hired him to help us with Yardi and to the financials, so we'd have great reporting. And then I jumped in and did the leasing and make-readies and maintenance and all of that.
Yeah. Wow. Okay. So how about you said you had a $25,000 budget for the roofs, but this thing needed to be updated. Yeah. Let's talk about the numbers, the financials. So from a marketing standpoint, how far off were your rents from market when you took it over?
I believe they were averaged about $475 when we took them over.
Okay.
I thought they could be $550.
Okay.
At the time. So when I took over, we started doing some renovations to the units, doing some upgraded paint colors, flooring, things like that. We did raise the rents right away to 550.
Oh, without even doing any rehab.
Well, we did do
The
rehab
light rehab.
immediately to the exterior. We renamed the property. We
I
got
bet you when you took those decks off, it made it look a hell of a lot better.
yes, and but all the doors to the second level are all on those decks too. So we had to find somebody that could take them down and put them up in one day,
Yeah, no kidding.
which we were able to do. We found a great deck contractor, and they came in and did them one building a day, and we had 5 buildings there.
Wow. Wow.
So we did the decks, we did the exterior first. All the plant beds were all overgrown and looked like one of those abandoned properties you drive by to see,
Yeah, yeah.
like stuff growing up everywhere. So clean that all up, put in rock around there, nice plants. So the outside then looked nice, put up new signage. Then we worked on the decks and the roofs, got those done. And then we just did the upgrades to the interiors as they became available.
Okay. How much do you spend on per interior?
I mean, it was minimal at the time. We did paint, lights, flooring.
Paint's like, okay, but hold on a second. If you went from 550, from 475 to 550, let me just, I love doing this part. This is another way. This is the fourth way you make money in multifamily. Let me do the math here. So let's just, okay, folks, I'm taking the increase in rents. Oh no, I did it wrong. 550 minus 475. And then I'm going to multiply it by 40 units and multiply it why can't I do it? It's, I tell you, Spencer, you can tell it when it's late in the day because I can't even work these big fat.
I can tell you the math on that really easy.
Yeah, I bet you can.
I knew every time with 40 units, we did a $25 increase. It was $1,000 a month in income.
Yeah, yeah.
And so we got that down real quick. We raised things in 25s.
and you probably had like what, about a 7 cap?
I think we went into it at probably an eight to an 8.5 at the time.
Okay, I'll put that an 8. So when you were done, I think that you're pretty done close to about close to $500,000 in increase in value. Your dad's as soon as you get that NOI up there, your dad's investment almost doubled.
Pretty exciting. Yeah, I can tell you within a year of owning it, we were able to do a cash out refinance with Fannie Mae.
Oh, wow.
Where we were able to pull out $350,000 out to go move it to to go buy another property and keep the income about where it was.
Wow. Okay, so let's talk about that for a second because you got your dad in here. And, the Spencer Cullor has been out there on the dating scene and he's finding the right woman. He's going to pop the question pretty soon. So now, this is your business. This is now, but you've got family. Your sister was a news anchor out there in Kansas City. And then you got a brother out there who's not in the business though, is he?
No, he's not. Although he may be joining me a little bit in the future. So.
Oh, cool. Why wouldn't he? I don't know. I'd be beating down your door. But so you and your dad are in this, and your dad brought the cash in. How was the structure? How did the two of you set up the ownership structure between the two of you?
Mm-hmm. Well, at that point, I was trying to prove myself. So I started the management company and got the management fees.
Okay. And the fourth way you make money?
Yeah, he owned it 100%.
Oh, he did.
Yeah, on that.
Wow.
Yeah, so
well, let me tell you, bravo to both of you. I mean, that's a great story. To
me, it was worth it because I was paying my dues.
Yeah.
I was working for a software company at the time, so I was doing this on the side. I worked marketing for them.
Oh, I did not know that.
Yeah.
I did not know that. Oh, that's
my job, making a great salary, and I started the management company. I made about 1/4 of what I was making in the corporate world the first year. But
hey, Spencer, you want your old job back?
Yeah. Well, what I saw was that what we could do in a year.
Yeah.
I was like, if I'm going to do this, we're going to go all in.
Excellent.
And so I took the risk. I was single at the time, and it made sense to if I was going to take the risk, I did it then. I was going to bet on myself.
Good for you. Good for you, man. That's awesome. And obviously, I'm joking, you obviously don't want your old job back.
Yeah.
No, you're doing pretty darn well right now. So that first, you pulled the money out. What'd you do with the money? So you just went and parlayed it right into the next deal. Now, okay,
Yep.
Let's follow up question. That was question part A. Question part B is, in the next deal, did the ownership structure change?
It did.
Good.
Yeah.
Good for you. Good for you.
Yeah.
As your attorney, I think I recommend
Well,
this.
and that's one you worked on with us.
Okay. Yeah.
Was a 72 unit deal.
72. Exactly. I was going to say it was 70 something. Yep.
Yeah. And so we took that 350 and that ended up moving over to the new deal that got treated as an investor would, but we put together an investor group to buy it. I think we came up with 720,000.
Okay. You need that to buy it.
And 350 came from the first deal.
How much out of that 720 was down payment, and how much of it was rehab money?
We were able to put that in kind of a structure that we put. It was funded with the deal, so we brought in a certain amount, and I think 210 of it, I believe, got put into a repair account.
Okay. Now let's add
funded in with the deal.
This particular deal had a lot of hair
on it. Yeah.
Yeah, I was gonna say. Yeah, because let me guess, you weren't working for that software company when you took on this deal.
No,
Yeah.
It was, I'd had this experience with the first 40, and it was in a great area and good renters, and then, it's still Kansas City. I'm thinking it's got to be the same, and we took on one with more challenges.
Okay.
About double the size.
How'd you find this one?
Off market again through another letter campaign.
Oh, actually. You kept it going. Okay, perfect. Yeah. Good.
Yeah, my first two deals we found with the letter campaign.
Who owned this one?
An attorney in town. That his wife had owned it managed it for a while. It was 72 units up in North Kansas City. And they had, I think, gone through a divorce, and he was going back and forth between Arkansas and there, and she had no longer managed the property.
Wait a minute. I know this guy. I remember this guy.
Yeah, it was a mess.
Yeah, I dealt with him at the closing table, didn't I?
Yes. Yeah.
Because you didn't want to.
Well, this was a mess. I mean, the whole thing was a mess. He had tons of deferred maintenance.
And he had a partner in it as well, didn't he? There was another guy sitting at the closing table with him.
He did. I never met that guy.
Okay. Yeah. So, here's a perfect example of an attorney that doesn't read contracts.
Yeah. And he was managing it from Arkansas. He'd come up one day a week to do like whatever he needed to do on site, and then head out. He had basically a maintenance guy managing the property at the time.
Okay, but but didn't he have an apartment there or something?
Yeah.
Oh, okay. Wait a minute. I'm trying to think here.
That I almost had to evict him out of.
Yeah, that's right.
It was wild. Yeah.
But I think this is the guy. I think I learned a lot myself on this transaction and added provisions to the purchase and sale contract that I learned from this particular transaction. One of which is you are not allowed to use security deposits to pay delinquent rents.
Yes.
Remember that?
Yes. Well, and that wasn't in the, he had security deposits in the contract, but at the closing table, it came with all these waivers that he'd taken people that owed him rent.
Right.
That
like $5,500
off to convert their deposits to rent that they owed him.
Yeah.
Instead of evicting them. Yeah.
So just so people listening to this will understand. So here's what happened. The guy had about $5,500 of security deposits that he didn't want to turn over to Spencer because he spent all the money and he didn't want to have it come out of the purchase price. So what does he do? He goes to all the tenants and say, listen, you know what money you got on the security deposits? Here's what we're going to do. We're going to take that money and it's going to pay your past rent and maybe, right up until closing. And therefore you don't owe anybody anything. Just sign this waiver. And of course, everybody's going to sign the waiver. And then all of a sudden, Spencer shows up and says, hey, I'm ready to take over. Give me the 5,500 security deposits because I'm going to need to fix these places when they move out. And the guy says, sorry, I got these waivers. All these people agreed to turn over the security deposits as delinquent to pay delinquent rents. So you get nothing.
Right. And we sat at the bank ready to sign the things and refused to sign
Yeah.
the closing documents until they agreed to credit that back.
And then I got the call, and I'm out here in Boston, and you're out in Kansas somewhere, and they're sitting at the closing table. And the little provision that people don't need to understand is that the way that the owner's bank worked is they would calculate the amount owed on a particular day, and that became the closing day. And if you missed that closing day, you had to wait 30 days to close again.
Right.
And so this guy's sitting there looking for his money, and he's trying to stiff you for the 5,500. And remember, we had that provision in the purchase and sale contract to protect you. And the guy says, no, you can't do that. I got these waivers. I don't owe you anything. I said, yes, you do. The contract says you can't use delinquent rents, security deposits for delinquent rents. The guy goes, show me where it says that.
Yeah.
Okay. And so I'm sitting there, I know exactly where it is. And I'm just taking my time, flipping the pages very slowly. And then finally, after about 5-minute pause, which was totally unnecessary, I say, look at paragraph K of section 9. There it is right there. And the guy says, and there's a silence on the other end. You can hear the two partners going back and forth. And the guy says, okay, fine, we'll close. And it was like, I remember calling you up and saying like, hey, took care of it for you, buddy. Took care of it for you. You're all set.
There's usually one moment in almost every deal that you have to just put your foot down.
Yeah. Yeah.
Almost every deal is like that.
And you got to figure out which battle do you want to fight? Which one's worth fighting? That one was worth fighting because you had them dead to rights on that one.
It was. And we've done really well with that property. It just, at first, it was painful.
Oh my gosh. Okay. Let's now, we talk about the good, the bad, and the ugly. This is one of the uglies. Just why don't you tell people what a day in your life was like during that first 6 to 12 months of owning that property?
Yeah. There was a lot of yelling at me by tenants.
Yeah.
A lot of evicting people for drugs or prostitution, and this wasn't in a bad area. This was just the property had been let go so bad. Nobody was in the asylum. So like the inmates were running it, and it had just it was a mess.
It's a beautiful property. The location.
Yeah, one of the buildings I remember nicknaming Eviction Row because out of the 12 tenants in that building, I evicted 10 of them.
Wow.
Because they all knew each other and
they all knew, hey, we don't have to pay because this guy's not going to evict us.
Yeah. So it was a painful process, and it had a bad reputation, and for a lot of very legitimate reasons at the time.
You start packing during that time, Spencer?
No, but I tell you, one thing we did right away was sent the rent roll to the police department because I had engaged them during the due diligence period about what was going on the property, and they told me a lot of things. I gave them the rent roll, and they sent it back to me with all kinds of notes on it, like, don't go in this apartment without us. They're known to have a gun. Don't,
oh my gosh, that's
evict this person. You need to get rid of this person, Yeah.
Wow. And how's it going now?
It's great now. I think when we took that property over, the rents were $495 on average for a 2-bedroom, 1.5 bath, 1,000 square foot. Now our average rents there are $845.
Oh my gosh!
So, and we figured out how to put washer dryers in there. We've got great tenants.
Oh my gosh, your dad is loving you. He never liked you as a boy, but now he loves you as a real estate investor. Holy cow.
Yeah.
That's fantastic.
It took 2 years to really turn that property around.
Okay, but let's talk.
And a lot of construction, deferred maintenance, changing the colors, changing the name, changing the marketing.
Wow. Now, what did give me some numbers. Give me some numbers. Like what happened to the, how much did you earn in that property as far as the increase in the equity?
Well, I would say we've over doubled the value of the property.
Isn't that unbelievable?
that we paid for it.
In 2 years.
Yeah, well, it probably took longer than that to really get to that value. It may have taken 3 or 4 to really double it, but within 3 years, we did 100% cash out refi with the Fannie Mae loan again. So we pulled out over $1 million on a $720,000 investment.
Wow. Okay, so wait a minute.
3 years.
When you say you did a cash out refi, you mean you did a supplemental loan on the Fannie Mae deal?
No, we went in initially with a bank loan, and then we refied it after getting rents up.
You did it on both properties?
Yeah, I've done it 4 times now. Yeah.
Oh, okay. Okay, excellent. Excellent.
The fastest one being 1 year, and the longest being about 3.
Oh, Spencer, you're doing it right, man. You are doing
it's
it
all
right.
about adding value to the property. When you can do that, it works out real well. If you
It's called, and I teach it, it's called the power of the cap rate.
Yes.
You know how you turn $100 into $30,000. And people are like, how do you do that? Well, on a Class A property that's at a 4 cap, you increase the rents by $100. You just increase the net worth of that property by $30,000.
Yeah.
And that's how the cap rate works.
When you talk about, not needing as many units and things like that, like I'd say in our first 150 units, that was 3 properties. We increased the equity in those 3 properties by over $5 million.
Unbelievable.
You don't need huge properties to do that.
Let me tell you, Doug Benson, one of my students, would be jumping for joy right now because he could not agree with you more, because that's exactly how he does it.
I've had 40-unit properties that make more money than a 100-unit property.
Exactly. Yep.
Everything's not equal.
No, that's great. That's fantastic. So let me ask you, because I want to get into the financing, because you bought a couple more properties since then.
Mm-hmm.
How do you finance your deals? And I don't mean by the debt side. I mean, we've talked enough about that. Let's talk about your equity raise. How do you go about doing that?
We normally offer a preferred rate of return and then a profit sharing structure on the upside.
Okay, what's your typical pref?
It's 6 to 8%. We do a range depending on the amount they invest with us.
Okay, so if one person puts in more money into one deal, the other person puts in less money in the same deal?
Well, we will do it based. It may be at 50,000, it's a 6%. At 100,000, it's 7%. At 150, it's 8%.
Wow!
On a preferred return basis.
Interesting. Okay, that's a cool structure.
And then we also do some incentives for people that have invested with us on multiple deals.
Okay.
So we have the ability, if they've been with us for multiple deals, maybe they get bumped up at % on those.
Okay. Have you seen the returns change over the last 10 years? Meaning, as the market has changed, tightened up, have you been able to, or do you have to change your returns?
It's something we always look at because things have gotten tighter.
Yeah.
As you go, and especially, the nicer, newer property you get on, the lower the returns are initially. So you have to do more to create the additional equity and the additional cash flow to cover like an 8% preferred return. That's may not seem like a lot, but that's hard to cover consistently and make money for you.
Yeah. That's such a true statement. People don't realize that might be the IRR that you have to rely upon, not so much the cash on cash. Now, so you talk about, the profit sharing afterwards. How do you split the equity? Do you come up with any funky thing? Because remember, you had a particular investor that only wanted a certain amount, and they were happy with it. Do you remember that?
Well, on our first deal, we did an 8% preferred return for everybody, but then we did a 20% profit split. 20% after that 8% went to the investor.
Okay.
And 80% of that went to us.
Okay.
That's how we started out. And then since we've changed that a little bit, but that was one I know you really like. I mean, it was hard at first because the first 2 years of that property were a real struggle. And we were able to pay the 8% to the investors, but we didn't make much money at all.
Yeah.
And then once we got the value up, we did the refinances and things. That's when we really benefited
Excellent.
from that.
Excellent. So what's good? Like if I were to,
upside on that property, but they got more of the secured up front.
all right. So if I wanted to get into one of your deals, what's it going to, what am I going to do? Like, what would you give me?
Usually, it depends on the deal, but no, most of them are 6 to 8% preferred returns, and then a 50% split
Okay.
on the back
Nice.
end.
All right. So let's tell me about, before I start getting into the real tough questions, Spencer, which you'll hit out of the park. Don't worry about it.
I do want to caveat this real quick on the first part, because I think we do something that's kind of unique
Okay.
with it, and something our investors have really liked. Once we paid them back 100% of their equity, we keep them in the deal. And so we have people that we've given their money back on a deal that then they continue to get returns as long as we own the properties or anything we've exchanged them into. Plus, then they take that initial equity, they roll it over into another deal with us. So they create multiple income streams off the initial investment. We've had people that have done that 2 or 3 times with us on the same money. So maybe they invested $100,000 at first. Now they're getting paid on $100,000 in 3 different deals with the same money. So I think that's something kind of unique that our investors really like. We don't cash them out of the deal.
That is incredibly unique, and I'll tell you why. Because I just did another podcast interview with a very, very successful multifamily investor who does the same thing that you do, except he now owns 100% of the deal. I have two of my clients who do the same thing. They don't keep the person in the deal, and they build it into the operating agreement that when we refinance, we're going to pay you off, and you can move your money into another deal, but you're out of this deal. And you're saying no.
That's interesting. Yeah. Well, we did that because a lot of people took a chance on us at the beginning. We wanted to reward them for the risks that they took with us. So we've set our whole structure up to protect the investor.
But what happens in this case is that all of your investors that stay in beyond the first deal, they have an infinite return.
Right. Nothing beats an infinite return. That's why it's hard for us sometimes to calculate the average return for an investor, because most of them are infinite at this.
That's what I was thinking. How do you calculate that? I mean,
it makes it more difficult. Yeah.
Yeah. That's great. Wow.
Yeah. Most people don't complain once they've been paid back.
Yeah. Let's talk. Okay. You and me, buddy. Let's talk. Okay.
Yeah.
Wow. Okay. So let's talk about, some of the, let's talk about your next deal. You don't have to give me any specifics, but kind of give us an idea of how'd you find it? Why'd you choose it? What do you like about it? What opportunities do you see in it? What problems do you see in the transaction?
Our next deal that we're working on now?
Yeah, that will be the next one added to the Cullor portfolio.
Yeah, we've got we've got 2 different ones that we're really looking at. They're both off market, ones that we've done a lot of research around. Our goal when we look into it, we really look at it as what can we do to the property. And on these properties that we're looking at, they're a little nicer than ones we've done in the past, a little newer and better areas. So we're really focusing on as good an area as we can afford that still has upside potential in the rents. So both of these properties, one of them I think is about almost 300 units. The other one's about 160. Both would probably trade at a 6 cap, and we can raise the rents on either one of them about $200 a unit in rent.
Okay. All right. So where are you in the transaction?
We are still in the initial. That's why I don't want to give too much away, as we're still
That's all we need.
Work on it, working on contracts and things like that. So
interesting. Good.
Yep.
So, hey, I got to tell you, took a walk down memory lane. I happened to hit on, going down the YouTube rabbit hole the other day, and I came across a video of Donny Osmond, and I thought of you.
Why is that?
Okay, you don't know why? Okay, because when I teach my classes, I show people a particular property that you can find on a special servicer website, and the name of the property is Park Place, and it's located in Branson, Missouri.
Oh, yep.
Remember that one?
I know that property. Yep.
So Branson, Missouri, Donny Osmond, Spencer Cullor, who never. Well, don't tell me I'm the only one that makes that connection.
Yeah.
Come on.
Yeah, well, this one that we're looking at is not in Branson, but
Okay. No,
yeah,
I went. No, that one's long gone. That one is
yeah,
long gone. I
yeah.
remember that one. Yeah, you were going to move down to Branson for that one.
Well,
So,
we were looking at some things. I think that would have been a great deal. We couldn't end up putting it. We couldn't end up getting the broker quite where we wanted it to be, and
yeah.
thought we had. I mean, a lot of things I'll tell you on these deals is that nothing's done until it's done.
Yep.
So you may
So
think
many
that
moving
you're
parts.
done. Well, one, don't tell anybody what you're working on until
Yeah.
it's locked up, and two, don't count anything until it's actually done.
Yeah.
There's a
Yeah.
lot of moving parts in most of these deals, and if you're looking at a 150 unit deal that you can add $200 a month in rent to, I mean, that's significant value you can add to that property. There's
Yeah.
maybe other people that might think that too. So
Yeah. Exactly. So, all right, here come the $1,000,000 questions. Tell me about, in broad strokes, tell me about the worst day you've ever had in this business.
the longer you're in this business, especially if you're around the property management side, you see a little bit of everything.
Yeah.
I mean, I don't know at the worst, but I've been called a lot of names. I'll tell you that. I had a lot of threats. It seems like every tenant anymore has an attorney on speed dial that
No kidding.
is willing to come in and take you take you on.
And the thing is, and I always say this every time I say, the thing I love about this business is the people I work with, the investors I work with, the people that are on the multifamily side, they're just the nicest people in the world. And Spencer, you're one of them. It's like, well, how can anybody call you a bad name, for crying out loud? Geez.
It's just, I think people are used to everything being easy. They expect in an apartment that you're never going to have a maintenance issue. And a lot of them think that it's like something personal, that you made this thing happen in their apartment, which doesn't make a lot of sense if you think about it rationally. But in the moment, it's not a lot of fun to deal with sometimes.
Yeah, exactly. All right, tell me about the best day. I bet you.
The best day is always closing day.
Yeah, yeah.
Exciting. You get to, if you structure it right, you're making some money that day.
Yeah. That's the fifth way you make money. He just named them all. The duck falls down, I give you $100.
Yeah. Yeah. So you're making money that day and you've got your whole plan in front of you. So it's just exciting to get it to go start on that next deal. One thing I love about this business is just, it's kind of a project by project deal. So each one can be so different, yet you've got so much opportunity in each one.
Yeah, that is so cool. That's so cool. So, all right, what advice would you give somebody starting out right now?
I'd say start local, start small where you're comfortable.
That's what I tell everyone.
And then actually learn the business, like work in it some and figure,
yeah.
Even if you don't end up being the property manager or stuff later on, it's nice to know exactly what they go through on a daily basis. One, so you can keep them honest, but two, so you know what costs should be, so you know what
that's huge.
Know how to communicate with that person that's managing. I mean, if you're hiring somebody you got to think of each one of these as a multi-million-dollar business.
Yeah, that's exactly it.
You don't want to hire somebody necessarily because they're $1 cheaper per hour. You got to think of somebody like, who do you want to steward over your multi-million-dollar business?
Yeah. No, I tell you, that's the way I look at it, is each property is like its own product line. If you look at, Johnson & Johnson, they have 1,000 different products. Each one of them, they look at separately. Same thing with all the properties that you own. Each one of them is a separate entity unto itself and has to stand on its own two legs.
Yes, definitely.
Yeah.
And if you do that, if you stay small, you start small, and then you make sure each project is profitable before you go on to the next, and don't spread yourself too thin. That's where we've grown slower than a lot of people, but our properties do really well.
Yeah, excellent.
And you sleep well at night when that happens. You're not worrying about, I've done a deal. It wasn't in multifamily, but just retail or office, and you worry if it's marginal. You worry about things all the time.
Yeah, when you build a cash flow business that just keeps printing money, it's a nice way to live.
Yeah, you sleep a lot easier at night.
Yeah, exactly.
And if something comes up, you can take care of it. If something unknown comes up, build that reserve so that when something does come up, you can take care of it and you don't have to worry about it.
Man, if you listen to all of my podcasts strung together, if you do one of those binge listenings, you'll be amazed at how many people just like yourself who are successful in this business say the exact same thing. That's the winning mentality in this
I
business.
think there's a reason. I mean, when you get started, there's so many things you don't know.
Yeah.
And I mean, that's why they hire you, is to uncover the things that they don't know,
Yeah.
to protect them from themselves when they're getting started. Because,
Exactly.
you know, a lot of times you're dealing with a large sum of money that means a lot to somebody. So you need to take care of it.
Yep, exactly. So, all right, last question. If you had to do it all over again, what would you do differently?
I think I would have started earlier. I would have started about 10 years earlier.
Okay, let me tell you something. Okay,
My dad will tell you too, if he would have known the power of this business, he would have never done the rock quarries and the ready mix concrete and stuff. He would have been putting all the resources into this business because it can multiply. So it's such a amazing wealth creating and income creating business that, yeah,
it's amazing to me. I got to just state here for the record that I have not had any prior conversations regarding this interview with Spencer. He did not know these questions ahead of time. But the thing is that you are not the third multifamily owner to say that exact same thing, that they would have started sooner. Yeah. But let me ask you something.
Yeah. 6 years ago, the market was a little different too. So
tell me about it.
What you could buy then and what it is worth now is so different. But
that's true. But even then, you still got to learn the business. You know, stay in it and learn.
Well, there's some people that get lucky and they get bailed out by a market, but that's fleeting usually.
Yeah, and it'll come back and bite you.
I'm telling you, the deals that don't go the way you planned are the ones you learn the most off.
Oh, tell me, why do you think I'm teaching now?
Yeah, why do you think I don't have any hair?
I know. He had hair when I started working with him. So, hey, Spencer, thank you so much for being a guest on the best multifamily podcast ever. It's always good to see you. You're one of the nicest guys in this business. I love working with you. I love being there at the beginning, and I love seeing your success now. It's so cool. So,
well, thank you, Charlie, and thank you for all your help along the way.
So, my pleasure. Say hi to your dad for me, will you? Tell him I was asking for him.
Definitely will.
Cool. All right. I'll talk to you soon.
All right. Thank you.
Bye-bye.